Good morning. Accounting 230 40998. We're about to enter a huge chapter in our book on long-term liabilities. So why don't we wait a moment, see if anybody shows up for the class, and then we'll take off here. Just excuse me one moment. Okay, the subject is long-term liabilities. Let me share a screen here. Hi, Derek.
How's it going?
Good, just getting started here.
Sounds good.
Okay, we got a pretty big chapter here, a lot to cover on liabilities. How to account for current liabilities, bonds, and a lot of bonds. Bonds you might find tricky at first, but interesting, I hope. Explain how to account for current liabilities. It's a debt that we know a company is going to pay within 1 year. Current liabilities can include notes payable, accounts payable, unearned revenue, and other accruals. What is a current liability? A or B? The 1 year or the operating cycle, whichever is longer. Notes payable, written promissory note, usually requires the borrower to pay interest, frequently issued to meet short-term financing needs, can be various periods of times, classified as a current liability if due within 1 year. A note payable is a formal written contract between a lender, between a borrower and a lender. Unlike accounts payable, which is based on credit, checks, and trust. Accounting for notes payable. First National Bank agrees to lend $100,000 on September 1st, 2022. If Cole Williams signs a $100,000 12% note, 4-month note, When a company issues an interest-bearing note, the amount of the assets it receives is going to be equal to the note's face value. So we are going to debit cash and we're going to credit notes payable. So that's pretty easy. Debit cash, credit notes payable. Now what happens in the future? If Cole Williams prepares financial statements annually, you're going to need an adjusting journal entry to accrue the interest expense. And that interest expense is 12% times $100,000, set up for 4 months because they borrowed the money on September 1st. $4,000 interest expense. Whenever you see a percentage, Derek, a percentage, it's always for an entire year, meaning you're going to have to go 12% times 100,000 is 12,000, and that would be $1,000 a month in interest. So there we go, interest expense, interest payable. Now it's time to pay back the note. Pay back the note. Well, they owe $4,000 in interest, don't forget. We accrued that $4,000 interest, so they're going to have to pay back $104,000. They pay back the principal of $100,000 and the payable that we just accrued of 4,000. Sales taxes are expressed as a stated percentage of the sales price. Selling company collects the tax from the customers. So we have a cash register reading here for Cooley Groceries, sales of $10,000, sales tax of $600 based on a rate of 6%. We're gonna have to record those sales and the sales taxes. So our revenue is going to be the $10,000. The sales tax is gonna be the 600, and the balance will be the payable. So we received $10,600 in cash from our customers. $600 of that is sales tax. That is not our money. That money belongs to the customer, and they are trusting us to turn that money over to the State Board of Equalization. If sales tax are not rung up separately, because the amount received from a sale is equal to the sales price, okay. Here they're just showing us a calculation, how to come up with $600. 10,600 divided by 1.06 is going to equal $10,000. It's just a way to break out the sales tax payable from the total cash. Unearned revenues. We should know what unearned revenues are. Unearned revenues occur when customer pays in advance for a product we have not yet delivered or a service which we have not yet rendered, okay? That becomes a liability. Revenues that are received before goods are delivered or services are performed. So we are going to debit cash and credit a liability account called unearned revenue. We don't owe the customer money, we owe them the service. When the company recognizes revenue, we will debit the liability and credit regular revenue. Superior University sells 10,000 season football tickets at $50 each for its 5-game home schedule. Oh, Superior University, they're a powerhouse, I understand. So it's $10 times $50. There we go. They sold $500,000 worth of tickets, 10,000 times 50. You debit cash, credit unearned ticket revenue, which is a liability account. As each game is completed, you record the earning of the revenue. So they play the first game of the home season, you debit unearned ticket revenue, and you credit ticket revenue. And that's sort of what we already learned in our first 4 chapters. Current maturities of long-term debt. You borrow money from somebody, and the deal is you pay them back in 20 years. The first year of that debt is always considered current. So here we go. Wendy Construction issues a 5-year interest-bearing note, $25,000 on January 1, 2022. It specifies that each January 1st, 2023, starting on 2023, Wendy should pay $5,000 of the note. When the company prepares $5,000, what amount should be reported as a current liability? The answer, if there's a God in heaven, will be $5,000, and the long term would be the difference, okay? You and several classmates are studying for the next accounting exam. Answer the following questions. If cash is borrowed on a $50,000 6-month 12% note, how much interest expense will be incurred by 12/31? Well, we just said that 12% represents a year. So 12% of $50,000 is $600, I believe. $600 or $50, 10%, 5,000. That'd be $6,000. It'd be $500 a month. And here we go. 50,000 times 12 times 4. That's 4 months at $500 a piece. Okay. The cash register total is 320, and the sales tax rate is 6%. What are the sales tax payable? Here, we got to go to that little calculation they showed us. We divide by 23,320 divided by 1.06 gives us the amount of revenue.
That for that calculation for sales revenue, if just for examples with like the sales tax, is it just going to be the 23,320 divided by 1 plus the percentage?
Yeah, that's the way to do it. Yeah, they're just showing you the shortcut.
Okay.
It's in other words, it's 106%.
Okay.
We know that the 23,320 is the gross number. If you divide it by 106, the other way to do it is to multiply by 0.06 and then subtract it, but they're just showing you a shortcut. That's all. If 15,000 is collected in advance on November 1, what amount of rent revenue would be recognized by the 31st? Well, 2 months would be. If 15,000 is collected, what amount of rent would be recognized? 2 months. Payroll and payroll taxes. Now, I don't think we're going to get into this too much because we have a payroll course here, and I don't think this is emphasized too much, but I'm going to go through it anyway. Payroll applies to salaries, managerial people, wages would be hourly people. Determining the payroll includes gross earnings, payroll deductions, net pay. Assume cargo records its payroll for the week of as follows. That's your basic journal entry to record a payroll, David. You've been a working person, I'm sure. Your check stub is the journal entry. Salaries and wages expense is your gross pay. That's the only expense to the company, the gross pay. So your gross pay is the 100,000. Then all the deductions that come out of your paycheck are for FICA, income taxes of different kinds, and then salaries and wages payable, that's cash. So your paycheck stub is the journal entry, gross pay to net pay. Gross pay being salaries and wages expense, net pay being cash. Record the payment. 3 kinds of payroll tax expense. Now they're talking payroll tax expense as opposed to a withholding. The employer we're talking about now. The employer is responsible for 3 taxes: FICA, FUTA, and SUTA, federal unemployment tax, and state unemployment tax. They call known as FUTA, SUTA, FUTA, SUTA. Based on cargo's $100,000 payroll, the company would record the payroll tax expense for these payroll taxes as follows. They're not showing you how they get the money, how they get those figures, but FICA is 6.25, is 6.2 rather, charged up to, right now it goes up, I believe, to 137,000 before it's capped. So 13,000, so your payroll, 100,000 times 7.65, that's what they're using, 7.65. Okay, FICA includes both Medicare and the FICA part. So 100,000 times 0.0765 is your FICA tax payable. And then federal income tax is usually a tiny number, 0.008. And state unemployment taxes can be a much higher number. And the state unemployment tax payable is controllable by the company if they have low turnover of employees. Employee payroll taxes do not include the federal income tax. Federal income tax is paid by the employees only. Let's see what we have here. Lake corporations employees earn wages of 60,000. Withholdings were so much for federal income, state. Costs for unemployment taxes were 90 for federal, 150 for state. So those costs, the 90 and the 150, that's going to be the employer's responsibility. Prepare the September 30 journal entries for salaries and wages expense and wages payable, assuming all wages are paid right away. So here we go. We're going to debit salaries and wages expense for 60. We're going to have the withholdings of 4590, 6500, and 2000. And there's our entry for the employee. The employer has to pick up the state unemployment, the federal unemployment, and this company also matches the FICA. So we're going to take the FICA number of 4590. We're going to add the 90 for unemployment taxes for federal and 150 for state. And that would be the journal entry for the corporation. Okay. Let's just a quick look at a payroll accounting entry. Now we get into something that'll test the brain a little bit. I happen to like this part of the course. Bonds. Bond. A bond is a loan. A bond is a note. It's an IOU. It's an interest-bearing note payable issued by companies, universities, governmental agencies. They can be sold in small denominations, or they can be sold in big. When a company issues bonds, it's borrowing. The person who buys the bondholder is investing in bonds, okay? Okay, we're the ones, in this chapter, we're the ones borrowing the money. Different kinds of bonds, A secured bond, an unsecured bond. A secured bond has collateral, if you all know that word, collateral. Secured bonds, I go to borrow money from you. I want you to loan me money with a bond. You look at me and you say, you just think you don't trust me. You say, Bob, hand me the keys to your car and then I'll loan you some money. That's a secured loan where the lender is protected. Unsecured is just lending on the credit of the borrower. Know these two terms too. These will come up on the test. Convertible bonds. Those are bonds that can be converted into common stock at the bondholder's option. You've bought bonds of Coca-Cola. Coca-Cola borrowed money from the public. They borrowed $1 million to start building a factory somewhere. You like Coca-Cola stock after a few years. You can then call Coca-Cola and say, sell my bonds and buy a commensurate amount of common stock. Callable bonds. This is an important one. Callable bonds. They can be redeemed by the issuing company prior to maturity. In other words, I loaned you money at 10% 10 years ago, and it's a 30-year bond, and it's a callable bond. Well, the interest rates are down to almost zero. I'm crazy for paying you 10% if I don't have to. So with a callable bond, I can contact you and say, here's your money back. Here is your interest through today, plus some kind of pre-agreed penalty or fee, and the deal is off. I don't know why anybody would buy a non-callable bond, to be honest with you, or sell a non-callable bond, I guess. Know the different terms. Bond certificate. In the old days, you used to get like a stock certificate, and it showed the name of the company issuing the bonds, the face value, maturity date. Face value. That is the principal due at maturity. Face value. That's the $100,000. That's the number with the bunch of zeros in it. No bonds are ever issued other than in increments of thousands or tens of thousands, okay? The maturity date is the last day of the life of the bond when the final payment is due. And the contractual interest rate is the annual rate used to determine the cash interest. A better word would be the coupon rate, the stated rate, the annual rate on that bond. And there's an example of a bond. That's a real fancy thing. And you can see that here, it's a $5,000 bond, and it looks like a 2-year bond, and 5.75% interest is due in 2021. so much in 2020, at the end of 2021. So a little look at an actual bond from the International Minerals and Chemicals. Bondholders can sell their bonds at any time. Prices are quoted as a percentage of face value. Corporation makes journal entries only when it issues or buyback bonds, or when bondholders convert. Market information for bonds. They're showing you that this bond here closed at 116.4. That means it rose in value since it was introduced at 100. The yield is 5.49 right now. So the bond originally was the 6.75% interest. You are going to continue to pay that. That's the stated rate. But the yield has come down because the price of the bond went up. The price of the bond went up, so that 6.75 calculates to a smaller yield. Determining the price of the bond. The present value of the bond is a function of three factors: dollars to be received, length of time, and something very important and very new: market rate of interest. We're going to constantly be looking at the market rate, Derek, and compare it to the stated rate on the bond. And the process of finding the present value of the bond is called discounting, and we're going to remove interest from future bond cash flows. Now, hold on here. Assume Acropolis on January 1st issues $100,000 of 9% bonds due in 5 years. Interest is payable annually. What we have to do is get what's called the present value of $100,000, which turns out to be $64,993. We have to get the present value of an annuity of $9,000 a year for 5 years, which equals $35,007. And on the next bunch of slides, they better explain to us what present value is all about, okay? So what we're saying is this bond is going out face value $100,000. That's what we're offering. Indicate whether each of the statements are true or false. Mortgage bonds are both examples of secured bonds. Unsecured bonds known as debentures, yep. Contractual interest rate is the rate the interest demand for the face value of the amount of a principal of the issuing company. What do we want to call that? That's the principal. That's what you're going to be paying. The market price of a bond is equal to its maturity value. No, not at all. Not at all. Okay, now hopefully we're going to get into present value, so you know how to do the calculations. A corporation records bond transactions when it issues or redeems, meaning buys back bonds. Bondholders convert bonds into common stock. Those are the two situations. Bonds may be issued at face value. You have a $100,000 bond. You want to borrow $100,000, and you're going to pay 5% interest. Well, if that's what the market rate of interest is, you'll get $100,000. But if the market rate interest is different, you're going to get a number either above or below. If you're paying 5%, say, and the market rate is everyone else is paying 6%, no one is going to give you $100,000 for your bond. You're going to get a number less than that. You're going to get maybe 96,000, 97. On the other hand, if you're paying 5% when everybody else is paying 4%, you're going to end up getting a premium. People are going to pay more than $100,000 because they love that amount of income you're paying, the amount of interest rate. The market interest rate is the contractual interest rate. Nope. Is listed in the bond. Nope. Is the rate investors demand. Number C. That's what the market is demanding. So if you're unwilling to pay 5%, you have to be prepared to take less money than $100,000. Candlestick issues 100,000 5-year $1,000 bonds dated the 21st, 100% of face value. So here we go. We're going to debit cash, credit bonds payable. How about that? The interest rates matched up. So we debit cash, credit bonds payable. And then we have to accrue interest at year end. And that was, what was that, 10% of 100,000, 12 months, $10,000 interest to accrue. Journal entry to pay the interest. Debit the liability, credit cash. Now, here we go, Derek. Here we go with the tricky stuff. Bond contractual interest is 10%. We're using 10% in the book, it looks like. If the market rate is the same, we'll get the face value. In other words, if we're paying what's called the market rate, we will get exactly the amount of money we're trying to borrow. But if we're paying lower than the market, which in this case is 12%, we're only going to get 90-something thousand. That's called selling the bond at a discount. Or if we're paying more, we get a premium. Laurel Inc. issues 10-year bonds with a maturity value of 200,000. If they're issued at a premium, this indicates that at a premium, it means that the contractual rate exceeds the market interest rate. That's a relationship, Derek, that you just have to have in your mind as you do these problems. If we're paying more than the market rate, we're going to get a premium. We're going to get 103,000. If the market rate is above what we're paying, it'd be the opposite. We'll get 90-something thousand. Assume on January 1st, 2022, Candlestick Inc. sells $100,000 5-year bonds at 98. So we only get 98,000 for this bond because we're not paying enough interest. We're going to debit cash for 98. We're going to debit a liability account, contra liability account called discount on bonds payable. And we're going to credit bonds payable for the whole fat $100,000. The bonds payable number will always be the one with the 1000 after it. No one in the history of the world has ever issued a bond for $107,813. You know what I mean? There are always increments of 1,000 of some kind. So what we have here is we receive cash, but we have to pay back 100,000. We only received 98,000 in cash, but at the end of this 5 years, we have to pay back $100,000. And this is how it would show on your balance sheet. Bonds payable, always the 100,000, and then you have $2,000 in the discount, and they'll show you the net bond payable. Okay, the net book value. The issuing corporation will pay the contracted interest rate, the coupon rate, which is 10%, even though the market rate might have been 12%, and the face value at maturity. Bonds issued at a discount. Bonds issued at a discount. Okay. Well, we have a bond being issued here for $52,000. 10% times 100,000, and an annuity of 10,000 times 5. Add the bond discount, which we said was $2,000. We come up with 52,000. Bond issued at a discount here, $100,000, 50,000 annual payments. That's the cash to be paid, less the cash received from bondholders. Total cost of borrowing. Amortization of bonds. Now we're going to amortize them. Take a look at this entry, Derek. We have a bond payable of $100,000. We have to get the net book value up to $100,000 in 2 years. And we're going to do it by crediting the discount every period and debiting interest expense. That's what amortizing is in this case. turning a discount or a premium into interest expense. So here we go. Amortization allocated to expense in each period. It increases the amount of interest expense reported. The amount of interest expense reported each period will exceed the contractual amount made. In other words, we sold this bond at a discount, so we have two areas of interest. One is the coupon rate, the 5%. The other is the amortization of the premium. As the discount is amortized, its balance declines or rises, depending if it's a premium or discount. The carrying value of bonds will increase until at maturity value equals their face amount. So let's take a breath here. Candlestick Inc. bonds issued bonds at 102. Now they're paying more than the interest rate that's in the market. So they're going to debit cash for 102 and show a premium as a credit for 4 or 2, I guess. Oh, 2, I'm sorry. I was comparing 102 to 98. No, 102 to 100. Debit cash, credit bonds payable, credit premium on bond payable. And again, here's the presentation. Bonds payable 100 plus 2,000. Remember, the borrower only pays the face value of the bonds at maturity and then pays at the end of the period the face value. Bonds issued at a premium again. We look at the bottom here. Principal at maturity 100,000. You have an annuity, which is a steady stream of payments over a period of time at the same interest rate. You have an annuity of 50. The amount to be paid to bondholders is 150. The cash you borrowed is 102. So your total cost of borrowing is actually 148,000. You got $100,000 in cash, but you have to pay back $50,000 in interest plus 2,000 in amortized interest. Let's look at a bond premium. Allocate to expense at the end of each period, and this will decrease the amount. You're going to have lower total interest expense because you got more than $100,000. The amount of interest expense reported each period will be less than the coupon rate. As the premium is amortized, the balance declines. Carrying value of bonds will decrease or increase until at maturity carrying value of bonds equals their face amount. Hold on here. So let's look at the issuance of a bond for 189,000. Okay, we should be starting to understand this first journal entry. You debit cash. The bonds payable will always be to that 100,000 incremental number, and the difference is a discount or a premium. Show how the bonds would be reported. Well, it's going to say bonds payable 200 minus 11,000 for the discount equals $189,000. Okay. Candlestick records the redemption of its bonds at maturity value. Well, they are going to debit bonds payable and credit cash because the net book value of the bond is now up to $100,000. Sometimes the company will redeem them before maturity. Remember I said if you're paying too high an interest rate and you have a chance to redeem the bonds, we might do it. So that's what we're talking about here. At the end of the fourth period, Candlestick, having sold its bonds at a premium, retires the bonds at 103. So they're going to pay 103,000. Doesn't look like there's any fees here. Principal and premium. So let's see how this works out. You're going to see a debit to bond payable for the 100,000. It looks like they're paying, what did they say? 103,000. So here's what happened. You debit bonds payable for the 100,000, you credit cash for 103. The $400 on the premium is what we have amortized for the first 4 years, and any difference becomes a loss on a bond redemption. You can have a gain or a loss on a bond redemption depending on how much you're buying the bond back for. Look at another one. R&B issued 10-year bonds at a discount. The carrying value, it was 496,000. The net book value of the bond was 496. They redeemed it at 98. Okay. So again, we're going to see a debit to $500,000 for bonds payable. The discount on the bond is 4,000 rather. That's the difference between the 500 and the 496. The cash is 490. The cash is 490. That's what it cost to redeem the bond at that point. And we have a gain on the bond redemption of $6,000. All right.
How do you determine that cash?
I want to think through your question just a second, because they're not teaching you something here. You are going to buy them back at whatever you think they'll accept in redemption. In other words, the deal is you can always buy the bond back. You're asking about the 490 in cash?
Yeah.
Well, the discount is $400, okay? It's $4,000. We've got that.
Yeah.
The bond payable is 500,000. 490 is the amount of cash when the current value is 496. Oh, here we go. The six, when you see that 6,000 there, you know that's not part of the principal of the bond. That's part of what's going to be a gain or a loss, and you come up with the 490.
Okay.
Yeah, that's just a simple explanation to get us started. What I'm surprised they're not showing us, Derek, is how to actually calculate those numbers. The best way I can answer your question is they're giving them to us. But every one of these numbers, like the 496, you would have to go to what's called a present value table, and get the amount of that number plus the annuity. So basically, they're just giving us these numbers right now, okay?
Okay.
How liabilities are reported and analyzed. Oops. Well, we know how they're reported and analyzed. You have current liabilities first, then your long-term liabilities. You have the bonds payable. Looks like they're showing those first, then the notes payable. Here's General Motors, 68 million. Look at those current assets. General Motors has 68 billion when you add six figures to this, like you're supposed to. They have 143 billion in non-current assets. Liquidity, okay. We've been over the current ratio, haven't we, Derek? We're seeing this for the first time.
Yeah, we've been over the current ratio.
Okay, well, yeah, current assets divided by current liabilities equals your current ratio. Measurement of liquidity. Solvency, we did this one too. Total liabilities divided by total assets. We did debt to assets. Total debt divided by total assets gives you 83%. It means that for every asset that General Motors has, they had to borrow 83 cents to get their hands on it. And it was 80% the year before. Times interest earned, this is a different one here. Times interest earned, that's net income plus interest expense plus income tax expense. This one you just have to kind of study and get it memorized. It's your income tax, net income, income tax, interest expense. Income tax, net income, and interest expense divided by the earnings. You get by the total assets, you get the 14.3. Yeah, let's have a little fun with contingencies. Contingency. A contingency, an event with uncertain outcomes that may represent potential liabilities. A contingency, you will get an A in the class if you study. I will lose some weight if I go on a diet. Contingencies. What we're really talking about here are lawsuits. Someone is suing us for some reason. We have to make a judgment as to whether or not it's a lawsuit that we're going to lose, or it's a lawsuit we're going to win, or it's a lawsuit we're not sure about. And there are 3 different handlings for those items. That's all they're saying about contingencies. Let me continue and see if they get back to that. Off balance sheet financing. Uh-oh, I don't know if I like this. An intentional effort by a company to structure its financing arrangements so as to avoid showing liabilities. Well, you can do that by issuing stock. Compute the current ratio. We know how to do that. Assume that Trout used 2,000. Boy, they're giving us a lot on the current ratio. Hint, hint. We know what working capital is. Debt to assets. We've got that. 24,000. You add up the 8 and the 16. Divide by 34,700. And the times interest earned. Okay. Now what we're going back to bonds again, Derek, and we're going to talk about how you amortize them. Remember, we issued a bond for $98,000. We wanted to get 100,000, but we only got 98 because our interest rate was inadequate. That means that difference of $2,000 has to be eliminated by the time the bond matures. And that's called amortizing the bond discount or premium. And let's take a peek here. The bond discount, we're starting with straight line amortization, which is very easy, very easy. We're going to take the discount amount. The discount amount in this case is, I don't like the way they're presenting this, but that's okay. The discount was $2,000. And it looks like it's for a 5-year bond, okay? So our interest expense in terms of a cash payment is 10% times $100,000, correct? We have a $100,000 bond, and we're going to pay 10% interest on top of that. But we have to amortize that discount into interest expense, and we do that with a credit to bonds payable. So on the credit side, you have 2 components of interest. You have the interest payable, which is the cash amount we're going to pay every year, and that's not going to change. And you have the discount on the bond. So now the bond was $98,000. Now it's gone up to $98,400. Next year, it'll go up to $98,800, etc. 3 more times till it hits $100,000, and then we pay back the $100,000. And here's a good look at it. This is an important screen. When we issued the bond, we only got 98,000, right, Derek? 98,000. So our interest to be paid is 10% of 10,000. So that interest expense is always going to be there. That's unchanged. All we did was take the $2,000 difference between the 198, divided it by 5, and added them together to get 10,400. And that's your $52,000 cost of borrowing they referred to a little bit earlier. So take a look at each year. We start off with 98. We amortize 400, we're up to 98.4. We amortize another 400 up to 98.8, up to 99.2, and ultimately 100,000, at which point you pay back the $100,000. So your total interest expense exceeds the amount of interest you're paying if you sell the bond at a discount. Now here, we got $102,000 for our bond. So let's see what happened here. The interest rates, we were paying more than the market. So our interest expense they came up with was $9,600 How did they do that? Well, again, it's 10% times 10,000. That's the amount of cash interest, that interest payable could say cash. And then we have a $5,000 premium. We're dividing by, what did we get that? 5,000? No, $2,000 premium divided by 5 gives you the 400. So we debit interest expense and we debit premium on bond payable. And notice that if you sell the bond at a premium, your reported total interest expense is less than the 10,000 you're paying. And here they're showing you the same grid. The only difference is we're starting off with a higher number, 102,000. 10,000 is always going to be the same, the amount we're paying. Here's the $400 per period in amortization. And now we subtract to get 9,600. So you got 102 minus 4 equals 1,016 minus 4 equals 1,012, all the way down to maturity when we pay the bond. The amortization method is not the best way to do it. It doesn't really match up revenues and expenses exactly right. The auditors will come in and check, and they'll say, how are you doing your bond amortizations? If you tell them you're doing it straight line, they're going to double check, and they may make you adjust for the difference between what it should be and what you were recording. In my experience, which is not much with amortizing bonds, when we used straight line, we were always close enough to effective interest where the auditor said, it's immaterial, don't worry about it. So now we're going to talk about the effective interest method. And this is a little trickier. We are going to have to compute the bond interest expense and the bond interest paid or accrued and compute the amortization amount. Well, that's what we were just doing. But let's take a look here. Now we're talking. Let's look at this grid now. Effective interest rate. I'm going to give you a formula that you need to write down and have in the back of your head. The carrying value of the bond, the net book value of the bond, times the market rate equals the total interest expense. I'm going to repeat that. The bond carrying value, which is also called the net book value, times the market rate equals the total interest expense. So what do you have here? You have a net book value of 98,000 times whatever the interest rate was, 10.5348. That equals $10,324. That's your total interest, total. We have to then subtract the coupon interest from that to get the amortization. So we started off with 98,000. We add 324, we get 98,324. We multiply 98,324 times 0.105348, and we start the cycle over again. That makes sense, Derek? Or you need me to go over that some more?
I wrote it down. If you want to just go over it one more time, that'd be helpful.
Sure. Yeah. What we're doing here with the effective interest rate is we're always going to be multiplying the net book value of the bond right here, right? 98,000. You multiply that by 0.105348. That gives you the total interest. That's what the formula is. Net book value of the bond times the market rate equals total interest. Total with a capital T, total interest. So that's our total interest. We know of that total interest, 10,000 of it is payable in cash. The difference is the amount that becomes amortizable. 98, in this case, plus 324. Then you go to the next year, Derek. Now we're down to 98,324. We multiply that by the market rate. We get 10,396 minus the 10,000. You get 396. What you notice here, when you're talking about a maturity of a bond at a discount, the amount of interest expense goes up every year. If it was a premium, it would go down every year. So I would suggest you just take a look at these two screens and get familiar with the difference. The straight line's very easy. It just takes that $2,000, divides it by 5, and you drop the number. Here, you have to calculate the total interest expense first. And that's the market rate times the net book value of the bond. And then we have to accrue some interest and amortization of the bond discounts. Let's see what we have here. Okay, they took that from the first year. You debit interest expense, credit bonds payable, credit interest payable. Where did we get that, Derek? Right from the first year. From the first year, we took 98,000 times 0.105348. That's our total interest. That's our debit to interest expense. This is our credit to cash. This is our credit to the bond discount. So when you're looking at this particular sheet here, that's your journal entry. There's your debit to total, there's your debit to expense, your credit to cash, and your debit or credit to what you're amortizing, a discount or a premium. There's our journal entry. And you repeat it for the second period. There, the discount amount is $358. $358, we go back over here. Here it is right here. We amortize, so you're amortizing a little more each period when the bond is sold at a discount. And now Candlestick decides to sell the bond in the open market, okay? They sell the bond described above for 102 rather than 98. Now they're getting a premium and they're paying the effective interest rate, which is the market rate, by the way. The effective interest rate is the market rate. So let's see here. We're going to have a $2,000 premium, and it is a premium because we got 102. 102 times your market interest rate equals 9,669. You subtract that from the interest to be paid, you get the 331. 102,000 plus 331 or minus 331 equals 101,669. 101,669 by your market rate equals 96.38, and you just carry along. Helping you out a little bit on that, Derek?
Yep.
Yeah, it's a tricky area. They're actually making it a lot easier than McGraw-Hill, the way they're teaching this. This is one of the first things in Wiley that I kind of like a little bit. And then you record the accrued interest. Right here. That came from that grid. Long-term notes payable. How to account for them? I think we know this. Notes may be secured by a mortgage. Typical terms require a borrower to make long-term notes. Typically, you make payments over a period of time, monthly, weekly, annually. And here they're just showing you a mortgage note. That's all this is. This person bought a house, okay? And the house cost them $500,000. All right? And they're going to have to make a cash payment every year for $50,000. $40,000 is interest. The rest is the reduction of principal. Just a mortgage. That's all. 500,000 times 8% is 40,000, and the annual payments are 50,926. So when these people bought this house, it looks like they set up a 10-year note. I wish I had that kind of money, Derek, huh? You buy a $500,000 house with only a 10-year note, and you pay it back immediately. And they record the mortgage loan like this: cash, mortgage payable. And then you've got interest expense and the mortgage payable and the cash. You have cash, mortgage payable, and then you make your first payment. We know that the interest expense is going to be 40,000. We know that the total cost, that the total agreed upon monthly payment is 5926. and that leaves the difference of mortgage payable. In a mortgage situation, Derek, typically your first few payments, almost little of the payable goes down. You notice that they're paying $51,000, but only 10,000 is going to reduce the mortgage. Normally, if it was a 30-year mortgage, that number would be like $30. It's that small when you start. And then as the payments go on year after year, each payment takes more and more out of the payable. And now we get into the foreign world, and I'm not going to do it other than suggest you just read looking for differences. That's all. There shouldn't be anything on the test on the international, okay? So that was a pretty busy chapter. Wouldn't you say, Derek?
Yeah, that was a lot.
It was a lot. Also, what they're not showing you is how to compute the numbers. In McGraw-Hill, they make you go to the tables and actually compute the rates, compute the annuities. They've simplified it a little bit here, which I think might be good. So
Yeah, it's easier to grasp some concepts, but I mean, usually you get the practice in the homework, like with the
yeah,
actual.
yeah. This shouldn't be too onerous. The McGraw, if we were still in McGraw-Hill, your homework would be a lot harder, believe me, because they make you dig up the numbers. Here, they're pretty much giving them to you, and then you have to know what to do with them, okay?
Yeah.
All right, so what do you think? We close our meeting now?
Oh, yeah. That was good.
Okay, we'll talk to you later, Derek, okay?
See you later.
Bye-bye, everybody.